first time when I was looking for this, the name of this chapter, I was thinking that what is this exactly, and practically this is much more like the basis of value at risk, the basis of the pricing of forward contracts or future contracts, and also the basis of option pricing. So today we will be watching and looking for many components and building bricks which will be used in later sections and chapters. So that's why it will be important to talk about this. But when I was processing the Annex C, I realized that first we have to start with the valuation of forward and future contracts before we go in, because this chapter will use all the information in this annex, so that's why it's better to stop in the main part of the book and then jump to the end, and then let's see that what is inside these 2 pages actually. So at the first, or Annex A, we were able to see that yes, we need to use continuous interest rates, because continuous interest rates are easier to calculate. We don't have to deal with these steps. It's always a line, and we can divide interest rates easily, and that's why future values or present values can be calculated this way. Just in the case of present value, this is in minus, so it's quite simple. Then last week I was talking about the zero coupon spot rates. So what is zero coupon rate? And at the end of the day we realized that it can be all the interest rates what we are using. So if we are trying to value in a contract with 1 year maturity, then we are looking for the for similar product, financial product which has an interest rate of 5 or 1 year, or if we are looking for 5 year, then also we can look for annualized interests, and practically this is what we have as zero curve. So we have a curve with different maturities and interest rates, and then we can use them. So I think that the definition is quite long, but practically this is that we need reference interest rates, and this is what provided. And also we can use it in bond pricing, and bond pricing will be not so important today, but next week we will go back to this one. For today, what is really important for us, that how can we price in future prices. So if we have no income in a future contract, then we can say that okay, this is the future price, this is the present price. So practically future prices are looking like that, okay, we are taking all this money into a bank deposit, and then it will grow with this interest rate here for this predefined time period, and when we are taking this up, so we are reaching the maturity, then this is the future price. And if we have any kind of income on this business, then we have to modify it with this number I. And if we have some yields, or sometimes it will be dividend in the different tasks or examples, then it's the same thing, just with the minus Q, which can be also familiar for us, because if it was growing perpetual, or it was a growing annuity, we had similar solution in corporate finance. Or if it's a foreign currency, then we have to take the difference between the domestic interest rate and the foreign interest rate. And also this is funny, because in this case these are the future exchange rates, this is the present exchange rate. So we can see here that this is the sovereign spread, or this is the what is the name? Interest parity. Yes, so the interest parity, what we can see here in this. And in many cases people are using it backwards. So if we are looking for expectations about future interest rates in a country, and we know the risk-free rates in foreign countries, so we know that what is happening in the US, how the US zero curve looks like, then we can reconstruct, for example, a Hungarian or a Georgian zero rate, because we just have to look for future exchange rates for US dollar euro relation. Also we have to look for the spot exchange rate, and then on this basis with the different time settings, then we can trace back that what is the expected, at least according to the current market knowledge and information, what can be the expected zero curves for the Hungarian forint or Georgian, it starts with an R, so a currency. Also, if we have a forward contract where we have the right to buy, so we have a long position or a short position, then also we can calculate the same way. We can see that, yeah, these are quite similar features. Just in this case we are not switching between future and spot prices, but now we are focusing on the target price, and we already know the value of the forward price here. So, and also right now we should not forget about that this is present value. So we are taking the difference between the actual future price and the target price, and then we are calculating the present value. Just it depends on the side of the contract that which one will be chosen. So these are all the basic information for us. And then let's see the book, because I'm not sure that this is maybe the best topic or title for this topic, but in the case of estimation of future cash flows, practically we can have this valuation approach, so which means that we are looking for expected values. So what can happen in average? So we can see on we are looking for what is happening exactly on the market, and in the case of scenario analysis we are looking for outcomes in the case of extreme circumstances. So what is has a probability of what outcome has a probability of 95% or 99%. So that's why in this case in scenario analysis we are stressing the result in the case of valuation, and we can run Monte Carlo simulation, just not in this section. So quoting Jeremy Clarkson, we can say that still could be worse. This is the expected value, or what can possibly go wrong scenario when we have the scenario analysis. So again, this is about expected values, and this will lead us practically to value at risk approach later on, when we are defining thresholds for the portfolio. And if we are reaching the thresholds, then the manager should do something, maybe purchase an option, maybe liquidate all the assets, but you have to do something. And or at least you have to have some capital to cover or absorb the losses or potential losses. So this can be also a solution that defining solvency capital. And yeah, so let's start. Volatility and asset prices. So first of all, everything in this chapter, and I think that the later part of the book will be about continuous compounding. So we should never forget about that. We will use everything in E, R, t and minus. So this will be your great friend here, this guy. I was thinking that I will color everything out, just it looked really ugly, so I turned back to black and white coloring. But also what will be really important for us, that practically at the beginning the book uses no natural logarithm, but sooner or later they will skip this and they will go for not using it, because they realize that we can use natural logarithm or we can use the Euler number, and then in this case we can skip this part. Also, we have an asset price right now in time 0. It will be always the spot price. Also, we can have a constant expected growth rate on the market, and also constant volatility. And right now it seems to be a bit romantic, but here we are assuming a really serious mean reversion. So the market maybe deviates from this expected growth rates and maybe deviates from the constant volatility levels, but it fluctuates around it, so it goes back instantaneously or really fast. It will be really important because later on then I will talk about conditional volatility, so gauge models. We will see that it can be time dependent, or not time dependent, time variant. So that's why we can see that we can fit volatility for each data points in the time series what we are analyzing. So we can upgrade all the models what we are looking for today, but we can make it also dynamic. So the Heston option pricing model can have this built-in function when they are considering the average value of the volatility of the volatility, the correlation of volatility with the change of the underlying asset price. So yeah, we can make this way smarter, but right now at least we have to understand what is happening here. So right now we have expectation about the growth rate and the volatility. And to do so, we have to assume again normal distribution. Normal distribution can be familiar for us about or from the first class, because when I was talking about risk and when I was talking about portfolio mathematics, normal distribution was appearing continuously, because we have to assume this. Why? Because mathematics are way easier if we are assuming normal distribution, because normal distribution can be calibrated with the expected value and also the volatility. And we don't need further parameters to do that. And also in this case, the volatility will be a finite number, not a function, as it happens in other alternate distributions. So and it's also really easy, because if I want to set some thresholds, we can do this relatively fast. So that's the reason why people prefer normal distribution, and also because normal distribution fits really well on market data around the expected value. So until we don't have once in a lifetime global financial crises, which are happening in every decade practically, if we are lucky, then if we are unlucky, then more than once in a decade, then it works well. If it happens, then it not works, and some banks are going to default. But right now, let's assume that we don't have a systemic crisis. We have much more like a competitive market, not an oligopolistic market in the financial system. So we can use this model, and now we can see that how can we calibrate this model. So if we are thinking about that, okay, let's take, or we would like to describe the price in the future, in the time t. So it means that, okay, we can take the current price right now, and also we can say that it will grow with a ratio, but also it will fluctuate. So let's say that, okay, we have this expected value, and around this expected value it moves back and forth, and this will generate some noise, and this t will create this time dependency. So it's first step it's multiplying by 1, in second step it multiplies by 2, and so on. So it's growing in some direction, and so this is the mean, and this is the variance. Maybe it's misleading because it looks like that we are multiplying with something, but there are spaces here and here. Yeah. And in the case of the variance, we can say that, okay, there is the variance in the data, it's also time dependent, so it's growing in time, and now we have to combine all these things together, because if we are assuming that the probability density of the data set is following this normal distribution, so we have all the ingredients here, so now we have the parameters for the m, which is this one, and also the parameter for the v, which is this one. Maybe I will put equation mark here because it's hurting my eyes. Now it's precise. Okay. Then we can say that, okay, let's describe the density of this. So what are the possible outcomes of the development of this price here as time passes? So we are putting the data here in a normal distribution, then we can build up the model by adding these variables. Just still, we can say that this is still a function because there is this comma here, or colon, something like this. So it's still not a mathematical equation, or at least not what we can execute because it's normal distribution dependent. But after that we can write everything up, because if we are doing the math, so the probability of having the price level under a threshold of V, it will always like that we have something position and we are under it or we are above it. Then it means that we can move into the level of logarithms at the same time. So mathematics are allowing us to move from, at least the relation will be the same. Doesn't matter that we are in logarithm or not logarithm. So we can say that the probability of we are under a threshold V will be based on the normal distribution. So in this case now we changed from this abstract equation based on the normal distribution. Now it's still inside, we are inside the normal distribution, but now we can solve this approach, because we can say that, okay, this is the V minus the spot price, and then we have this fluctuation around the expected value and also the variance, which changes in time, and also, good evening, and also we have to divide this with the probability. And we can ask the question that why are we doing this this way, and if we are looking on normal distribution power here, but we can see that we can find a similar function. So we can, after that we can use this one. And we can say that, okay, but being smaller or bigger in the case of price and the level of threshold, it will be really important for us when we will using or evaluating options, or maybe when we are evaluating the value for futures or forward contracts. So this is actually the core of the valuation of this kind of derivatives. And in many cases, people are using this approach that they are saying that, okay, this is the D2 component. Again, it will reappear in the case of black source pricing. Just in this case, it will be the target price, and the rest is will be highly familiar for us. But still, again, in this case, this is only for normal distribution. So if we are moving away from normal distribution, let's say student T distribution, this is supposed to be completely different because the parameters are absolutely not the same. So that's the elegance of using a normal distribution, because we can describe it really easily. Just the problem is that we are completely talking about well-behaving markets without any systemic meltdown. But until it performs well. So if we are fitting this on historical data set and we are carefully removing all the recession periods, then it will be fit and nice. Okay, so how can we do this calculation? Practically, if we are doing the math, here is really graduate school mathematics, but at this part, when we are including the normal distribution in Excel or in I will use Google Sheet today, we have this normal distribution function. So we can use it easily, and we don't need any tables or other approaches. So we can simplify this calculation easily. And that's why I will always include the Excel equation. Just I cannot use my own Excel because it's Hungarian and all the functions in Excel are translated, unfortunately, so that's why I will use the Google product. But at least in this case I can share with you at the end of the day everything, so we will see how can we use this and how can we automatize this kind of calculations. Then we can have also the opposite position when we are under the or over the threshold, not under the threshold like it happened here. The same thing happens, just in this case we have the D2 is not negative anymore, it's positive. And after that we can say that, and still if we need the expected payoff, then we will multiply the payment and the derivative value will be around this one. So expected payoff and the present value, what we know that it's the ion minus RT, so this is present value or discounting stuff for calculating present value. And also what will be really important for today, because it will appear so many times, that the probability of being under or above this threshold will be this Q probability. So which means that if we are under something, that we have to add this number. In this case we have to take away this number, but we can see that still we are using this average component, and we are using the variance component, just we are modifying it with the appropriate level in the case of the bell curve. So we are looking for that, okay, this is the probability of let's say 5%, then we are using this inverted or inverse of cumulative normal distribution function. So we are looking for what is the appropriate change which can be connected to this probability in the distribution function, and then we will modify the volatility component of this asset. And also what is really important here, because practically when we are considering this here, or even the normal distribution, so it doesn't matter that I'm calibrating this one or that one. No, sorry, it only happens in this case. So when I'm calibrating this one, I'm always thinking about a standard normal distribution. So it doesn't matter that I have expected value here and then volatility or variance there. Here I have to set in the function all this data as an input, but after that the mean will be 0 and the standard deviation will be 1. So it's standard normal distribution, because it's absolutely not mentioned in the book, and if we are changing the numbers, then we have surprising results. So it's a friendly reminder, and then we can see that, okay, this will be the value of the V here, so if you are executing all these things. So how can we use this knowledge? We can use it in many different ways. So first of all, the biggest benefit is that we can use this risk-neutral valuation. So in the risk-neutral world, we can say that investors require no compensation for bearing risks, which is quite a romantic approach, because we are expecting then that the required expected return from risky investment equals with the safe investment. So why to do this? The reason is because in this case we can jump between a risk-neutral world and the real world, and in many cases this can be an elegant solution. So we can have models, simplified models for the risk-neutral world, and then we can convert them to the real world, because we have some nice or at least elegant assumptions here and solutions to make this happen. So first of all, this risk-neutral valuation is used for derivative valuation, and in this case we can assume that the world is risk-neutral. Why? Because derivatives are always dependent on the price of the underlying asset. So it means that even if we don't care about the risk of the investment, practically all the risk will be represented in the price of the underlying asset. So if the price of the underlying asset is changing due to risk, then we don't have to care about twice, because it's already there. So that's why we can move above this neutral world. So price changes will represent risk changes, and that's why the value of the derivative will be independent from the risk preferences of the investors, because price changes will do all this job, and that's why we don't have to reflect this anymore. So practically we can say that if we have the cash flows about expectations in the future, then we can discount it. So we can take this present value component, and also we have a risk-free interest rate, which is also nice. The problem is that, okay, but how can I define risk-free interest rate? So is this maybe an interbank market interest rate, or is this T-bill rate, or is this a long-term government bond rate? So it sometimes depends on the literature which one to choose, or which one is not negative during the last decade, or which is the less volatile. So I was able to see 10-year yields to use for this purpose, or I was able to see 1-year LIBOR benchmark. Now we know that it's outdated, but so there can be different approaches for this risk-free interest rate. Let's keep it as an abstract. variable here, just because we can think about that in practical life. We have to still assume it somehow, estimate it, and we have the following steps. So if we have the expected future return on a stock, and it's something, so this will calibrate this one, so expected growth rate. Then we have the expected payoff from a call option, because we know that what will happen there. And then we have the options value, so we are discounting the expected payoff and at this expected other risk-free rate. So I don't like, but the book was using the same numbers, and okay. And then at the end of the day we have the artificial device for evaluating derivatives, and in the real life we can have expected differences in expected payoff and the discount rate, and that's why I will show you some examples when it's happening and how can we compensate this one. It will be also interesting to see. Okay, so that's why practically if you have to remember something from this slide, then these are the steps. So future return and all these things, what we have to do, remembering on this slide and practically the bottom of this slide with the blue parts. Then we have to calculate the expected payoff, then we have the discounted value, and then we are happy most of the cases, or still we have to deal with or connect it to the real world. Okay, so what is relevant for forward contracts or future contracts, because we were able to see that they are quite the same. So we have long forward contract in this, and later on we will have a short one, but let's start with the long version. It's a non-dividend paying stock. Okay, so we can have the delivery price, we have the time to maturity, so this is the big T, this is the K, and in the case of the maturity, the value will be the difference. So this was the price at time T, and this is the delivery price. We are taking the difference, this is the value. I think it's quite obvious. The problem will be that if it's we are not at time of maturity, because obviously we are not creating forward or future contracts with an immediate maturity, because hedging would be not efficient in this way. Maybe if we are operating on overnight markets, or we are high frequency traders, then we can be close to this approach, but yeah, this would be a highly specialized case. So let's think about what is happening if we are moving away from this time of maturity. We can say that we have an expected time, or we have an expected value at time T. So this is the A, and we can say that in the future this thing will be expected. I have no idea what is this right now, but we have something. And of course, since we moved away from this expected value, then I have to discount this to have the present value here. So obviously we need a present value component. And then we can move forward and we can say that, okay, but we can take this into two parts. So first of all, I don't need the expected value of the delivery price, because it's constant, it's not changing, and I know this because this is written on my contract literally. So I just multiply it with the A, and still we can keep this expected thing here. And this is in a risk neutral world. So we have this discount element here, so we are now able to say that okay, we divide it into two parts. So we are still in the same thing, just now we have present value, and this is expected, nothing more. Then we have this expected growth rate of the stock price, which is R in a risk-neutral world. So we can say that, okay, we can convert this guy here, so the spot rate, because we know that if this thing works well, then in time this is supposed to follow this rate of growth, which are represented by the R, which is right now it's a future value from discounting. So it grows in the future, and sooner or later we will reach this, but we are taking its present value. Obviously, if we are going back and forth, so this guy here meets this guy here, and then they will eliminate each other. So this one is the opposite of this one, so that's why. At the end of the day, we have only the S0 will remain here, and we eliminated all this stuff. So we can say that okay, we have the spot price and practically the present value of the target rate, or delivery price here, and it's nice and easy. Practically we could say without all this solution. I like this that the book here was able to describe this, because now we can see that okay, how can we achieve this conclusion here. But even if we don't know, we don't have any idea about how they were coming here, still we can say that okay, but practically if we are looking on the value till maturity at the time t, so if I'm setting this t to 0, then okay, it's S0, and I know that in the future I can get some delivery price, then I have to take its present value. So okay, this one is much more elegant and nicer, and we need this knowledge, just we can think about that. With some common sense we can approximate this one. And if we are going backwards with short forward contracts, then we have the same thing, just with the opposite signs. So this one is negative, this one is positive, and yeah, that's all. However, let's move towards options. It's again for a call option, European call option, and the stock is non-dividend paying stock, so we don't have to deal with dividends. And it's funny because European call options we can calculate easily, but American call options, they are way more a nightmare. So in this case, still we can define it in Excel, because I was able to see examples for that, but yeah, MATLAB is easier at that time to calibrate, because we have nicely defined functions for that. Okay, so in the case, because we are talking about options, so still there is a target or strike price, we have time till maturity, we have risk-free rate, we have time. Yeah, there are two things are the same. And again we can start with similar approach, so value at maturity, payoff at time t, when we are reaching the maturity. Then we can say that okay, once it can be the difference between the actual spot rate and the strike price. If it's bigger than 0, then we are happy. If it's not bigger than 0, then it will be 0, so we're not able to lose, and that's why it's maximized. So one of them supposed to be there. And expected payoff in a risk-neutral world would be, again going back to this approach. Going back to this approach when we added this expected value. would be that, okay, same thing, just now we have expectations. And that's why if we are adding the present value, so this is the expected payoff, now for the value we have to calculate its present value, so that's why we are discounting here and there. For a call option, then we are just adding this. Still we have no idea how to do this, but at least now we have a nice approach to describe that what is happening here. Also in the case of put options, this is completely the same, just with the opposite signs here. So this one is negative, this one is positive. In the case of this, during the Black-Scholes equation, we will continue the expansion of this one, but right now the book says that this is enough, because now we need discrete outcomes and also we have to add probabilities. So first, if you would like to ask probabilities, let's talk about simplified cases. So we have one derivative which pays off $1 at time t in case of outcome 1, and in case of outcome 2, which is the other sole possible outcome, we get nothing. And the value of this thing is p. And we have a second derivative which pays nothing in the case of first outcome, time of maturity, and in the case of the other possible, solely possible outcome, we get the $1, and the value is p as well. Sorry, it's p2, so it's another value. And obviously, if I'm saying that, oh, okay, I don't care, let's purchase both of them, because in this case, I'm sure that I can get something. So I'm purchasing the P1 and the P2 and paying the money for this, because these are the values. Obviously, I will get this wonderful $1, and practically what I'm doing right now, that I'm buying the present value of this $1. So that's why the reason that it's just 1, because altogether if I'm adding these oppositely related derivatives together, then I can get present value. So this is also an important lesson here, because after that, when I'm saying that, okay, I will get not 1, but V1 and V2 payoffs, then the value of the derivative will be immediately different. So right now I can say that, okay, first I can start with this. So I get some money. And then I can expand it, that, okay, that I have this here, but let's move all the p's out, and we will have a nice weighted average. So the important, or the value of the P1 from the entire portfolio and the value of the P2 from the entire portfolio, and then both payoffs are considered. And then we can say that, okay, but in this case, these values will, because they are mutually compatible, so altogether this is certainty of 1. And that's why this ratio will represent that I can get this V1 money with P1 probability, and I can get this V2 money with P2 probability. And after that I can add up this thing. So let's put together everything, and now we can say that, okay, the entire value of the derivative will be this weighted average of the V1 and V2. Just in this case, the weights will be the probabilities of success. And of course, we should not forget about our friend here, the present value, because now we have the same equation like here. I don't know why, so the book's supposed to include this one here. Just I was thinking that they wanted to continue everything until they were reaching this conclusion. Just here it looks so strange that this is not included. Let's put it here because it's not elegant to miss it. Yeah, because we are talking about values, so it must be considered. Oh no, yeah, okay. Please don't freeze. Okay, autosave. I realize why they did not include it, because still we are extending or expanding this first equation, so that's the reason. But just I should not push buttons. Okay, so we have this. So this is the expected payoff in a risk-neutral world, discounted at a risk-free rate. So this is the risk-free rate. This is, we are doing the discounting. Still, we don't have any kind of risk at all. Just this money is paid with this probability and that probability. That's all. If we don't have just two outcomes, but we have n, so lot, but still they are mutually exclusive, so only one can happen at time. So and altogether they are representing all the certain outcomes. Then it means that just we have to have this again weighted average thing, and still we have to calculate its present value. So I think after that this is obvious that okay, from moving to 1 and 2 cases to I or n, because I can be everything from 1 till n, so it's happening. Okay, and after that later on when we will talk about credit derivatives, so how companies can go to default, and that's why how can we secure ourselves against their default, then still it will be highly similar. So we have to estimate the risk-neutral default probabilities, then we have to calculate the expected payoff from the instrument and discount the expected payoff in the risk-free rate. And also when I will show you how can we do this CDO or CDS calculations, for example, when the Reuters or Econ database does this, they are taking already existing CDS spreads or yields of bonds data, and they are tracing it back. So they are using some bootstrapping analysis methods to have these default probabilities. It's funny because it goes backwards from real market data to provide us data to have our calculations this way. So it seems to be a bit circular, but okay, this is how we can generate the data. Okay, so until now we were talking about valuation, but now let's see scenario analysis. So scenario analysis is much more about the real world, not the risk neutral world. So risk neutral world was about calculating or estimating the expected value. Now we have to stress it. And there is this Girsanov's theorem which says that the expected growth rates of the market variables can change. So stock prices can change, commodity prices can change, exchange rate changing, and so on. So we were able to say that okay, they can move because they are representing the underlying changes in the risk. So let's go back here. So we can remember that price changes as risk changes. So this is the background of this theorem. But volatilities remain the same. Maybe volatilities can also change, but they are since they are conditional, so I can estimate for each time t period when I'm doing the valuation, and after that this derivative will be fixed to this volatility. In the case of Gauss model, I will show it to you, and it's quite a robust solution. So several years ago, I was talking with people from Morgan Stanley, and we were talking about that. Oh, Black-Scholes model seems to be so outdated nowadays because it uses normal distribution, and still we can modify at least, so improve it with conditional volatility. But they were also saying that, okay, but people in market using it because it's easy to assume, and it's quite robust. Sometimes it can be problems, but still we can say that this approach is not just elegant, but mostly it's also robust. Okay, so the big question in the case of scenario analysis is that how much could we lose during the next year? So what is the capital or money or investment at risk? So in the case of the regulations, laws, at least for credit institutions or investment funds inside the European Union, and I think that as well, they are always having these thresholds of 95% or 99% of certainties, and we have to always calibrate this value here, and it can be also really familiar because we already defined it with the many blue lines slide. So this is when it was born, and then we were able to reach this after this many different steps. So today things are looking really ugly, but at the end of the day they will be really streamlined when it will be about practical issues. So what we have to do here is, okay, I will have this value, I have the current spot price, and I have some expected growth rates, I have some volatility, I have the time until maturity. I will calibrate this one by using this will be 5% or 1%, it depends on, and still I have this volatility here, still I have the time, so it's classic mathematics. Okay, this one is not, but we can use Excel to solve this, and once I have this V, then let's take the difference between the spot price, multiply it with the number of shares, and then also we have to calculate its present value, and then happily I have the position. So yeah, what can possibly go wrong? Of course, we can add the change of time. So later on, when we will have this, yeah, it's looking much more like Brown motion, because actually it's not. The reason is because all these things was based on the model of Brownian motion when this random walk hypothesis was generated. So yeah, so things are happening due to time changes, and that's why if we would like to define future spot prices, then we can have these assumptions about the changes in the pricing equation. So later on we will see this, because actually the Heston option pricing method improves this just with another layer. It's a secondary Brownian motion layer, not just a primary.